Ladies and gentlemen, good day and welcome to the Skipper Limited Q4 FY23 results conference call hosted by Centrum Broking Limited. As a reminder, all participant lines will be in the listen-only mode, and there will be no opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touch-tone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Rahul Mishra from Centrum Broking Limited. Thank you, and over to you, sir.
Thank you, Lizan. Hello and good afternoon to everyone, and thank you for joining the Skipper Limited Q4 FY23 earnings call. From the management side today, we have Mr. Sharan Bansal, Director, Mr. Devesh Bansal, Director, Mr. Shiv Shankar Gupta, Chief Financial Officer, and Mr. Aditya Dijari, Deputy General Manager of Finance and Investor Relations. Without any further ado, I will hand over the call to Mr. Sharan Bansal for his opening remarks, post which we can open the floor for Q&A. Over to you, sir.
Thank you, Rahul. Good afternoon to you all, and thank you for your continued interest in Skipper. Please take note, any forward-looking statement made during this call must be reviewed in conjunction with the risks that the industry and the company face. The year was filled with many achievements and milestones for the company. We are glad to share some of those marked achievements with you. The company registered its best ever revenue quarter of 657 crores, showcasing strong momentum across all major business segments. We achieved our highest ever quarterly revenue of 149 crores and annual revenue of 406 crores in the polymer segment. On back of strong volume growth, the growth has been achieved purely on account of volume, which shows the rising market acceptance and pull for our polymer products. We expect this trend to continue in the coming years. We've also achieved the highest ever engineering export sales and volume. The export revenue for the year stood at 723 crores, registering a 80% year-on-year growth. We've achieved the highest ever annual order inflow in the company's history, securing new orders in excess of 4137 crores during the year. We've secured our largest single order win, valuing at 2570 crores from BSNL during the year. The year-end closing order book stands at 4551 crores, which is the highest ever in company's history and is well diversified across sectors and segments. We also have the highest year-end bidding pipeline. We're actively pursuing projects worth 6600 crores in international front and 3520 crores on the domestic front. We've also ventured into water EPC work for the first time and secured an order of 100 crores for JJM, Jal Jeevan Mission projects. We've become the first Indian pole manufacturer to successfully design and supply transmission monopole structures to North America. And we've successfully executed 2 transmission pole supply contracts with one of the biggest transmission utilities in Canada. We've successfully supplied large quantities of towers to largest ever transmission line projects ever being made in Australia. This project is called Project Energy Connect, and it's located in New South Wales, Australia. We've received first-time orders from countries of Dominican Republic, USA, Canada, Iraq, and Kuwait during the year, taking the total export reach to 55 countries worldwide. We've tested and supplied guide towers for the first time. 12 towers were tested in our in-house test station in the R&D center in a single month, which is a record. The sector continues to witness uptick in both ordering and execution, and the company expects growth to gain further pace with increased participation opportunities across the globe. Some of the key operational and financial highlights in comparison to previous year and quarter were as follows. There has been strong revenue performance across our major business segments in spite of inflationary cost push and geopolitical related challenges, while maintaining healthy operating margins of 10% plus. The net revenue for the quarter stood at 657 crores against 553 crores previous year quarter 4, which is up by almost 19%. The segmental revenue breakup are as follows: engineering 497, which is up by 20.7%. Polymer 149 crores, which is up by 26.4%, and infra segment 11 crores. The full year consolidated revenue stood at increased by 16% over previous year to 1980 crores. The segmental revenue breakup for full year were as follows: engineering 1524, up 15.3%, polymer 406 crores, which is up by 27%, and infra segment 50 crores. The company achieved highest ever engineering export sales of 723 crores against 400 crores previous year, registering a growth of 80%. Our export share in overall engineering revenue stood at 47% in 12 months FY23, in compared to 30% last year. Forex derivative M2M losses arising on account of sharp depreciation of rupee has resulted mainly in decrease of profitability of the current year by rupees 24.3 crores. And there was a simultaneous increase in the previous year corresponding period by 19 crores. The nature of this forex loss is largely notional. Thus, all comparative growth numbers are required to be calculated excluding this effect of forex adjustment for better operational performance understanding and analysis on like-to-like basis. Our yearly operating performance, excluding the impact of forex gain loss, were as follows: operating EBITDA rose by 46%, EBITDA increased to 217 crores instead of 149 crores. Standalone operating EBITDA margins improved to 11% in comparison to 8.7% in FY22. The Q4 23 operating EBITDA percentage was at 10% against 11% last year quarter. Engineering segment operating EBITDA margin for the year improved to 12.8% in comparison to 10.7% in previous year. Now we are clocking the desired margin range of 12 to 13% for many quarters. The consolidated operating PBT for full year increased to 71.3 crores against rupees 11.3 crores last year, which is a major increase of 531%, while operating PBT margins improved to 3.6% instead of 0.6 last year. The operating PBT for the quarter was 24.7 crores comparison to 23.9 crores previous year quarter. Our JV Skipper Medzer India LLP, engaged in the business of manufacturing of drip and micro irrigation systems, has turned profitable and reported a PAT of 57 million during the year, with 5.7 crores. The consolidated financial results include our portion of the same. The consolidated reported PAT increased to 35.6 crores against rupees 25.2 last year, registering a growth of 41%. Some of the notable improvements on the balance sheet and cash flow front are as follows. The total gross debt as on 31st March 23 stood at 484 crores against rupees 567 crores last year. The company has been able to achieve this reduction in debt by rupees 83 crores in spite of higher sales during this year, on account of efficient working capital utilization and better collection and payment terms from debtors. Achieved significant reduction in overall debtors by 85 crores in comparison to last year in spite of higher sales. Gross debtor days improved to 70 days against 100 days. The focus and steps undertaken towards balance sheet consolidation resulted in significant improvement in cash flows of the company. Our net operating cash flow for the year increased to 284 crores from rupees 17 crores in FY22 on back of strong underlying earnings and efficient working capital management. The debt equity ratio has improved to 0.63 against 0.77. Further, some notable developments on the government policy front which will have a positive bearing on the company's growth and performance are the restoration of RoDTEP scheme in our engineering product business, which will boost our export competitiveness and potentially improve our operational performance. The company will also get benefited from the India-Australia Free Trade Agreement. Our engineering products are now eligible to enjoy preferential market access and duty structure in Australia. This will boost our export competitiveness and future growth. The recent government announcement for transmission system plan for integration of 500 gigawatt of renewable capacity with an investment outlay of 2.4 lakh crores in domestic transmission projects is also a big positive for us. Further, I'm glad to share that Skipper Pipes has onboarded MS Dhoni and Chris Gayle as brand ambassadors to help raise awareness about safe water supply. For Indians, MS Dhoni is not just a cricketing icon but also an embodiment of values such as trust, reliability and resilience, which perfectly align with the values of Skipper Limited. It's a well thought out brand strategy to position ourselves as a leading player in the industry by associating with the skipper or captain of Indian cricket himself, MS Dhoni. Skipper Pipes has been certified with highest standard of NSF 14. The campaign aims at creating awareness about 100% lead-free and NSF 14 certified PVC pipes for Indian households and the importance of using best-in-class lead-free pipes for potable water solutions. Thank you. I'm happy to take your questions now.
Thank you. Ladies and gentlemen, we will now begin with the question and answer session. Anyone wishing to ask a question may please press star and 1 on your touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Participants on the conference, if you wish to ask a question, you may please press star and 1. The first question is on the line of Rahul Mishra from Centrum Broking. Please go ahead.
Yeah, hi. Thanks for the opportunity, and first of all, congratulations to the management on a very good set of numbers during the quarter. So I have a couple of questions. But to start with, so the bidding pipeline, as we see from the presentation, it looks very healthy at 66 billion for international orders and 35 billion for domestic market. So if you could help me understand what all sectors are these offers are likely to come from, and if you can put any timeline on when the tenders would be awarded.
Yes, so effectively our bidding is largely to the EPC players who are either in turn bidding for these transmission tenders, or in many cases they have already won those projects and we as a supplier are bidding to them. So we have active relations with a number of global EPC players, and many of these bids which we have submitted with them, we are in advanced stages of finalization with a number of them. So every quarter we are expecting inflow about 400 to 500 crores of order inflow, which is what we have been maintaining for last several quarters. It is yes, so as they are looking at the demand prospects, we feel that this bid pipeline will continue to grow. As we have mentioned, it's 66 billion in international front and about 35 billion on the domestic front right now. We are also expecting more bids to come up in the domestic side this year.
Sure, thanks. So my next question is pertaining to the same tender pipeline. So if you can help me understand what could be the net margin profile for these tenders. I know like the tenders would be a mix of international, domestic, EPC contracts. So if you can just put any number, any figure to that for the margins.
Yeah, so on a consolidated basis, we are confident of delivering 12 to 13% margins in our engineering segment. We have in this year also our operating margin has improved across the company significantly to 11%, and I think for engineering segment, do we have the full year margin? Engineering segment also we have seen good margins for the full year. So you can expect 12 to 13% margin for the engineering segment. Yes, for the full year, this year, engineering segment, we have delivered 12.8%. So 12 to 13 is what you should be expecting for the incoming orders as well.
Sure, sir. So my next question was pertaining to one of the slides in the PPT where it was mentioned that there is a pent-up demand in the domestic T&D space as most of the tenders that got postponed will now be conducted in coming months. So if you can just throw some light on what all states in the domestic market we are seeing this pent-up demand.
Yes, majority of the tenders are catering to renewable power integration. So we expect majority of the tenders to come in Rajasthan and Gujarat side.
Okay. And considering most of the tenders would be awarded from government entities, so how would you see the working capital position, in terms of receivables? Means, what will be the average receivable days while you are working with the existing government stakeholders?
We are not seeing any challenge in terms of receivables. As I mentioned in my remarks, we have brought down our debtor number of days to 70 instead of 100 plus debtor days in the previous year. So we are as such not seeing any challenge in realization from whether it is domestic side or international side.
Okay. Fair enough. So my next question is for the telecom towers, considering that we are the largest manufacturers and suppliers of telecom towers. So given the government's thrust on adding new 8 lakh towers over the next 2 years, how are we placed in the industry in terms of market share, and what is the revenue as well as margin potential from this order pipeline of 8 lakh towers?
We have recently won this large BSNL contract also for setting up an installation for 4G towers in rural areas. We are seeing more such opportunity as the 5G expansion and investment takes momentum. So I believe that Skipper as the largest player in this segment, we will continue to see better and better opportunities in the telecom space also, just the way we are seeing in the power transmission space, and the margins should be in line with our overall company margins.
Okay. My next question again pertains to the telecom segment. So what is the current share of revenue coming from telecom sector, given that we have recently won a big order from BSNL, and going ahead, if you could secure some orders, similar orders like these, can it become a significant contributor to our engineering product segment after exports?
Yes, possibly you are right. Currently, if I look at the year that just ended, telecom would be maybe less than 15% of our overall revenue. But yes, with the BSNL contract as well as other opportunities in the telecom sector, we may see some increase in that in our overall revenue mix.
Sure. I have some more questions, but I will join back in the queue. Thanks for all the replies, sir.
Of course.
Thank you. We'll move on to the next question. That is on the line of Sachin Kasera from Swan Investments. Please go ahead.
Yeah, good afternoon, and congrats for a good set of numbers. First was on this big contract that we received from BSNL. So if you could give us some clarity in terms of how do we see the execution and the ramp up and the working capital cycle for this specific order in financial year 24.
Yes, sure. So the contract is a mix of CAPEX and O&M. So the 65% of the contract value will be realized in the next 2 financial years. That means is FY24 and FY25, which is the CAPEX part of it. And the O&M part, which is about 35 to 40%, that will be realized over the next 5 years after the sites are installed. So that is how we are expecting the revenue to be realized. And in terms of working capital, it should be in line with our company overall working capital, currently whatever we have.
No, I was asking if you could be a little more specific, like in financial year 20, execution of 60%. how should we look in terms of how much execution should happen in 24 and 25? If you could give that breakup roughly, will it be like equal 50-50, or it will be more like much less this year and major execution will happen in 25 basis, whatever interactions you have?
It will honestly depend on site conditions, as the project has just kicked off. So it is too early to say what will be the exact revenue. Of course, the government does want more revenue to take place in this FY24 itself, maybe because of the elections, but it remains to be seen once how the speed on the ground picks up. We definitely expect that the 100% of the capex part of the revenue will be realized in FY24 and 25, but the split between the 2 years, it is too early to say.
And any sense on when has the execution started full-fledged, or when would tentatively start in terms of full-fledged execution? Any sense of that if you could give us?
Yes, the execution has started in a number of the clusters in the area that we have.
Okay, sure. Second question was on the margin in the engineering business. So this year we have seen almost a 200 basis point improvement at 12.8%. And in one of the previous queries, you mentioned that you expect it in the range of 12 to 13%. But in one of the slides in the presentation, it has been mentioned that you are expecting the share of exports to rise to almost 75% over the next 2 years in the engineering business. And this is from whatever we have interacted, and you have mentioned in the past conference calls that the margins in exports are much better. So if the share of export is going to increase from 50 to 75, should we not aspire to have better EBITDA margins in the next 2 years?
Well, we would certainly like to do better than 12 to 13% margins, but as and when the export grows, hopefully we will do better margins also. As of now, we are guiding for 12 to 13% margins only.
Sure. Secondly, on this bidding pipeline in the engineering business in the domestic market, does this include some of this? You mentioned that almost 8 lakh towers are to be installed. So this domestic pipeline, it is mainly on the T&D side, or this domestic pipeline again includes some other circle orders like the one that you have recently won?
In the domestic pipeline, the share of telecom is lower, but yes, there are some telecom opportunities also included in the domestic pipeline.
So this few other circles that you mentioned, if you could give us some sense, what is the overall size of this 5G rollout opportunity ecosystem? Because I think what we have on is just few circles, right? And you mentioned the total installation has to be around 8 lakh towers. So if you could give us some ballpark picture, what is going to be the size of the market, what is like a tentative timeline in which we can expect the bidding to happen, and who are the key players, how are we positioned, that would be very helpful.
See, the overall 8 lakh towers will be a combination of towers put up by all the operators and the third-party tower companies in India. So it is difficult to comment on individual plans. This is the estimate put up by various sources that 8 lakh towers will be required in the overall 5G expansion, the network expansion. So as such, definitely opportunities are increasing. We are seeing more and more bid opportunities in the telecom segment. But giving a circle-wise breakup would probably not be possible at our end.
Sure, but at least on the BSNL side, if you could give us some indication, because I'm sure that's more of a government tender-based business. So how many more bids are expected tentatively in financial year 24, if you have some insights on that?
No, BSNL currently what we are doing is the 4G saturation project. As of now, they haven't announced any other project which they are going to undertake. But it's expected that as they also move to deeper penetrate their 4G and 5G expansion, they definitely will be coming out with more projects. But there's no confirmed plans in hand for us.
Sure. Just last question on the export side of the business. So now that we have got significant approvals, and when we are seeing some of the other companies which are in the listed space and in the adjacent categories like supplying conductors, addressing the same industry, they are seeing very strong order book from North America. In fact, some of them also seen very strong execution in the financial year 23. So if you could share some thoughts in terms of how are you seeing the ramp up and the order inflow and the visibility for the North American market?
Yes, North America is an interesting opportunity. The conductor manufacturers have an advantage because their conductor sales go into reconductoring projects also. However, towers and poles are typically used when only new lines are built. So I'd say that we have entered the North American market last year with some small orders. We are expecting some significant size orders in the coming years. But in terms of revenue, as of now, because we don't have large orders from the North American market, so we don't expect much revenue from there to come this year also. Only when we receive some significant orders from that market, then the following year we can expect some significant revenues coming in.
But over the next, say, 2 to 3 years, can we see significant order inflows from this North American market?
Yes. There are a number of projects which we are pursuing right now. So yes, we are quite hopeful that we should see good order inflows from North America as well as other developed markets like Europe and Australia as well.
Sure. And just one question on the balance sheet. If you could share what is the capital expenditure plan for financial year 24, and are we envisaging any net debt reduction planning for FY24?
We are planning a total capex of approximately 75 crores in this current financial year FY24. And in terms of debt reduction, we have been consistently controlling the overall debt, including working capital. As I mentioned in my remarks, we have been able to bring down overall borrowing by approximately 70 to 80 crores, even in this financial year, despite the growth of sales.
Sure. Thank you.
Thank you. The next question is from the line of Deepak Poddar from Fire Capital. Please go ahead.
Hello. Hello.
Yes, sir.
Yep. Thank you very much, sir, for the opportunity. So first up, I just wanted to understand in terms of revenue mix between the polymer, engineering product and infra. How do you see the revenue mix currently, which is at maybe 75-25%?
Yes. The current revenue for us, 79% is T&D and engineering and EPC, and 21% is polymer currently.
Correct. And 5% is infra, yeah.
Yeah, so your question is?
How do we see the revenue mix going forward?
Going forward, well, we expect growth in both the businesses. So definitely, we expect that polymer segment should grow in overall revenue mix of the company because it is growing at a much faster pace than the engineering business. So we do expect in the coming years polymer to take a greater share in the overall revenue.
Correct. Understood. So ideally, I mean, we have been, vocal about what 25% CAGR over the next 3 years. So ideally, the polymer should grow at what 30-40%, and engineering product would grow lesser than 25%, right? To have that console level 25% CAGR.
Yes, that's about right.
So, and in terms of potential for margins in your polymer division, how do we see that? I mean, currently it is only at about what 5% odd, right? So how do we see the potential in polymer? I mean, as we scale up, because ideally then it's EBITDA margin dilutive, right? At a console level.
Right, but then obviously you would have noticed that the industry average EBITDA margins are very healthy in this business. We are positioned as a premium brand in the markets that we operate in.
Mm-hmm.
Our EBITDA margins are low right now because we are a young brand and we are still investing in our distribution and our channel sales. We could see a consistent improvement every year in the EBITDA margin going forward.
Mm-hmm. Okay, so what's the sort of margins that we would aspire for in this business? Is it 10-12% is what the aspiration would be for us on the medium term?
In the longer term, we definitely would aspire to be close to the industry average, which is in the range of 13 to 14%.
13 to 14%.
Yes. in the long term.
Okay, I got it. I understood. Yeah, that's it from my side, sir. All the very best. Thank you so much.
Thank you.
Thank you. The next question is from the line of Vignesh Iyer from Sequent Investments. Please go ahead.
Congratulations, sir, on good set of numbers. I just want to understand if I take this closing order book and exclude the BSNL order from that total order book, so what would be a normal execution period for this non-BSNL order book?
For the non-BSNL order book, you can assume an execution period of approximately 12 to 18 months.
Okay, fine. And for second question, if you could just, so I do understand there is other nature of interest payment that, I mean, except for your long-term debt that you hold in the books of accounts. I just wanted to know, so what would be the breakup of this 32 crores that we paid in, quarter 4 and 104 crore odd interest that we paid in, entire year. What is the nature of the interest that is being paid? If you could just give me a breakup of that entire amount.
104 crores is overall finance charges. So that includes term loan interest, working capital interest, as well as interest paid on all LCs discounted for our sale bills. So the interest, the finance charge, as well as charges made on account of bank guarantees, etc. So all that inclusive is contributing to finance charges of 104 crores.
I understood. So, but if you could not give me the number, if you could just tell me what is the cost of funds of term loan and working capital loan separately, so just that I get an idea at what is the cost of loan that we hold in our books.
So the average cost of loans would be somewhere ranging from 8% to 9%. And if we talk on the interest cost per se, so it was 5.6% in last financial year, and the just concluded year, we have done 5.3%.
This is as a percentage of revenue.
As a percentage of revenue. And,
yeah, that is
Okay, fine. I'll get back in the queue. Thank you.
Sure.
Thank you. The next question is from the line of Sachin Kasera from Swan Investments. Please go ahead.
I had a couple of questions on the polymer business. One, if you could share with us the volume that we have done in this current financial year versus the last financial year.
Our company doesn't report volume data. We are the value data only.
Sure. But most of the players in the industry do share, but it's fine as per the company policy. Second question was with respect to, if you see the last 3-4 years, because we were implementing this TOC concept, we did not see much growth in terms of revenue and profitability. And a lot of these players who were much smaller than us have become much larger, and even some of the larger players have grown to a very big size. So because of which our market share has become much lower. So now that we are through with this, what is the type of aspiration we have? Because, today it's like a 30,000 crore industry. We are like 1% market share. So for us to be relevant player in the industry, we, at least have to reach some significant amount of market share. So either on a regional basis, do we intend to be a dominant player, want to become a national player all India? If you could just tell a bit from a 3 to 5 years perspective, what are our aspirations in this business? And how do you think are we positioned to be able to meet those aspirations?
Yes, sure. Devesh, would you like to take this question?
Sure. So you're right. The headroom available for us in this industry is quite large. As you mentioned, we're at only about a 1% market share. So there's enough room to grow for a player like us. The TOC working that we have done over the last 3 to 4 years has built up a great distribution network for us. So the presence that we have across the areas that we operate in is quite strong, and we are now reaching out to almost 30,000 retail touch points on a regular basis. With now the launch of our branding activities as well, we hope to be able to capture a substantial part of this market. The market, you're right, has grown significantly in the last few years, and it is going to continue to grow, especially with all the investment that is happening in the water sector by the government as well, this market will continue growing for the next many, many years. And we hope to play a big part of it going forward.
But from what my sense memory goes back, you were close to around 2% market share or 1.5% market share 4-5 years back. Today we are closer to 1%. Should we assume that at least in the next 3-4 years we aspire to go back to that 1.5 to 2% market share at least?
The aspiration is to obviously be much higher than that. We'll see how it works out.
Sure. And secondly, do we want to be a more focused on eastern region where we right now have a major presence and look at a much more dominance there, or eventually we want to be a much larger and a pan-India player, but that would also mean significant investments both in terms of distribution, marketing as well as capex? If you could give your thoughts on that.
So currently East and Northeast are a very strong market for us, and we enjoy a great brand presence as well as decent market share in these markets. This will continue to grow, but we are also very well present in North India now as well as parts of South India. So the idea is to continue expanding geographically as well as consolidate our position in East and Northeast further. So I see both of these two things happening going forward.
And currently your manufacturing is mainly in Eastern India?
Yes. Currently the manufacturing is in 2 plants, one in Calcutta and one in Guwahati.
And what would be the capacity at both these plants?
Consolidated capacity currently for polymer business is around 60,000 tons per annum.
60.
Yes.
And what would be the average utilization currently we would be working at? And
current utilization, while we don't generally disclose the volume numbers, but currently the utilization for the pipes business is approximately 50%.
And do we intend to set up any plant in North India, because you mentioned that North India is also a big focus area for us?
It's not in the current year's plan, but we'll see as we go along.
Sure. Thank you.
Thank you. The next question is from the line of Vignesh Iyer from Sequent Investments. Please go ahead.
Yes, thank you for the opportunity again. Just to understand it, what would be our guidance for probably the next 2 years in terms of revenue? I mean, if you could tell me, except for the BSNL orders, because it has its own execution cycle, right? So if you could just let us know what would be.
Your question is the execution period of the non-BSNL order.
No. I want to know what is the guidance in terms of the revenue that we would generate from the EPC segment, excluding the BSNL order, because BSNL order has its own execution cycle, right? So what do we have any guidance for, I mean, your regular orders that you're getting based on that?
Okay. You're specifically asking about the EPC segment only.
Right, EPC segment. Right.
Okay. So our EPC segment is not very large. We do have certain projects for transmission line and railway electrification projects. So we do expect to do maybe 40 to 50 crores of revenue in those areas. We have entered into the space of water EPC and secured our first project. So we do expect revenues from that division to now come in. So overall, you can say that non-BSNL infra revenue should be in the range of 100 to 150 crores odd.
Okay, and then the new, sorry.
Sorry, once again?
Yeah. So just to understand, this water EPC, the water project that we have got, does it have a different EBITDA margin profile, or it is similar to what it is right now?
The water EPC business will be having a similar margin profile from our existing businesses.
Okay, fair enough. Okay, that's all from my side. Thank you.
Thank you. The next question is on the line of Sachin Kasera from Swan Investments. Please go ahead.
Yeah, just 2 small questions. One is on the interest cost. So this year it is close to around 5% of revenues. Going ahead, while obviously there may be increase in working capital, hence net debt may not come down, but over the next couple of years, do you think that we can run a far more efficient operations and try to reduce this to like 3.5-4% of revenues, or this is the optimum at which we would be working next 2 years?
Yeah, I think finance cost is a function of obviously the working capital you are working as well as the interest rates. As we all know that during the year, interest rates have increased substantially. So probably the effect of the improvement that we have achieved in the overall working capital management has not been so easily visible in the finance cost because of the rising interest rate. However, now I believe that with further improvement in the working capital management, there definitely is an opportunity for this number to go close to 4%. But whether that will happen in this year or next year, it's hard to say. But yes, we do believe there is an opportunity to go below the current level of 5% that we are at.
Sure. Secondly, 2015 to 2018, when we were, doing very well as a company, our ROCs used to be in the range of 24-25%. Now they have recovered to like 12-13%. With this type of improvement in terms of mix towards exports, and now the also positive outlook on performance polymers and this strong outlook on the BSN order, next 2-3 years, do you think we can once again aspire to get 18-20% ROCs, or that was like one of time and hence like 14-15% ROC is what we should look at, a far more stable and a sustainable ROC for our business model?
I think 20% plus should be definitely the long-term aspiration of the company.
Sure. Thank you. All the best.
Thank you. A reminder to the participants, anyone wishing to ask a question, may please press star and 1. The next question is from the line of Rahul Mishra from Centrum Broking. Please go ahead.
Yeah, thanks for the follow-up. So my question pertains to the polymer segment. So as we see that we are targeting to increase our touch points from 30,000, means we are targeting to double our touch points from 30,000 currently to 60,000 in the next 2 years. Could you elaborate how are we concentrated region-wise? I'm sorry if I may have missed it during the call. So if you can just give a brief understanding, like how are we concentrated across India?
Yeah. Devesh, you want to take that question?
I am not sure about the figure of 60,000 if we've reached that figure. But the idea is to continue exploiting the current distribution network that we already have, which is itself very large. So for us to grow even from the existing distribution network is very well possible. And of course, we'll continue expanding the retail base as well. So both these things will happen. Okay. And the concentration region-wise, which I mentioned earlier as well, East and Northeast are our strongest markets, obviously, wherein we have very good brand presence. But North India has also come up very well, and parts of South India as well.
Okay. Sir, if you can help me understand the mix of whether we sell it through the brown outlets or we sell it through multi-brand outlets. What is the proportion between the two among the 30,000 touch points?
So all the retailers in the market across the industry in the PVC business, very few retailers, if I single brand, or the entire retail base is multi-brand only. So we operate through these people only. The distributors that we have are exclusive. So the distribution is exclusive, but the retailers are all multi-brand. And that is a common phenomena across the industry.
Sure, sir. So can you give us a breakup between the organized versus unorganized market share for the PVC industry, and are we seeing any industry consolidation going ahead with the share of organized increasing?
Yes, for sure. So I don't have the exact figures, obviously, but then our assumption is that the organized to unorganized share in the PVC industry is about 60-40, and it is increasing further. So as we go along, we'll see the exit of a lot of unorganized players, and organized players will continue to grow.
Sure. Thanks, sir. So my next question is, like I was going through the PPT and it was mentioned that the non-T&D product share in the total order book, the total outstanding order book stood at 62%. And we are currently following the strategy of increasing our non-T&D proportion from railways and telecom. So if you can just elaborate a bit on like which particular sector among these two would be fastest growing? And in case if it is railways, then what would be the scope of work that we could get?
So we definitely see a lot of opportunities from telecom, and on the back of this present order as well as other orders to come up in the coming years, we definitely see tremendous opportunities in the telecom segment. Railway also is a decent size segment for us. There are, although railway electrification opportunities are probably lesser compared to last year, but we are on the lookout of other opportunities in the railway sector also.
Okay. And with respect to railway orders, so what would be the proportion of projects or orders which are fixed priced contracts?
Mostly the contracts do come with pass-through margin, pass-through clauses in terms of raw materials.
Okay. So my last question will be on the international business. If you can just throw some color on like how many countries we are currently present in and how many we plan to enter in the future. And since we also mentioned that international business would constitute 75% of total order book in the next 2 years. So are we saying that we will be extracting more and more revenue from our existing reach in the international market, or we will be tapping more export opportunities? And with this scale up in the exports market in the engineering segment, how significantly it will add to our margins and profitability? Like we have already highlighted that we would be maintaining a margins at 11 to 13%. So can we see like a additional 100 or 200 bits? I may be saying it on a higher side with this scale up in export segment.
Yes, it's perfectly possible. So as and when exports keep growing, so the growth in exports will come by two ways. One is that by the addition of more and more new markets. As you know, every year we are adding 7 to 8 countries in our overall export reach, and of course greater engagement with the existing buyers and stakeholders, where we are gathering a bigger share of their wallet every year. So that's how the export growth will continue, and that's how we are targeting to take it up to 75% of our revenue, which is also by the way expected to grow at 25% CAGR every year. Yes, definitely with the improvement in export order book and execution, we can target better margins higher than 12 to 13% in the future.
Okay, sure, sir. So my last question again pertaining to international business, that is exports market. So which all countries firms are we seeing that they are participating and means can give a good competition in the exports industry, and how are they faring currently?
Could you repeat your question, please?
Yeah, so I was saying that what other countries firms, like from which countries are we seeing competition in the international business, like either from Turkish firms or Chinese firms?
Yes, essentially we are seeing major competition from, historically we've seen competition from Chinese and Turkish companies, and from the Middle East also there are a few companies, although smaller in size, where we do see some competition.
All right. Thanks a lot, sir, for all the answers. I'm done with my question.
Sure.
Thank you, sir.
Thank you. A reminder to the participants, anyone wishing to ask a question, may please press star and 1. Participants, if you wish to ask a question, you may please press star and 1. The next question is from the line of Rahul Mishra. Please go ahead.
Yeah, hi. Thanks for the follow-up. Sir, I have just one last question. So since we ventured into the water EPC works with the first-time order of 1 billion, and given the government's thrust on providing tap water connections to all rural households, so there is likely to be a surge in demand for PVC pipes. So can we see incremental orders into this segment?
Yeah, so you're right. With almost 80% of the Indian households now getting connected with piped water, which was not there earlier, there is definitely going to be an increased demand for plumbing pipes, which is going to be with PVC and CPVC. So over the next few years, we expect there to be very healthy demand for plumbing pipes and plumbing products from across the country. And we hope that with our retail presence that we have in different geographies, we'll be in a very good position to take advantage of that. So it's a very exciting time going forward.
Thank you. The next question is from the line of Chirag Jain, an individual investor. Please go ahead.
Sir, am I audible?
Yes, you are.
Sir, just wanted to understand your thought process with regards to debt currently. So I know you are at a low debt to equity, but what would be your thought process with regards to repayment of the same? Because if I go back and look about 5 years back, at that time, about similar level of debt, we were paying interest of about 50 odd crores. Currently, we are having a high interest burden, which is what is eating into profitability. So just wanted to have an understanding, because you communicated in the current Concall that your average cost of borrowing was about 8 to 9%. So in future, what would be the interest payment?
So I think, as I mentioned, that the overall interest cost, actually finance cost, which is inclusive of not just the interest outgo on the debt, it is inclusive of all the other charges, which is the discounting charges which we pay on our sale bills, as well as the bank guarantee charges which we pay in order to obtain bank guarantees, etc., for our business. So I believe that the finance charges are in line with our overall business, but as I also mentioned, there is an opportunity to reduce this with better working capital management in the years to come.
So, sir, in the year which is coming by, would we see the overall finance cost going down as compared to, because you're talking about increase in your top line also. So finance cost will increase in commensurate with your top line, or then because of your prudent measures with regards to working capital, it will come down?
Yes, the effort will definitely be that on a percentage basis, we should see improvement in the finance cost as a percentage to revenue.
Thank you, sir.
Thank you. Ladies and gentlemen, that was the last question. I now hand the conference over to the management for the closing comments.
Thank you, everyone. We are confident of profitable revenue growth of high double digits with a consistent margin in the current year, and expect new growth in excess of 25% CAGR for the next 3 financial years on the back of pending engineering contracts and strong polymer segment performance. Our diversification into international markets and sectors will help us pick and choose higher margin orders which are coming our way, and provide us with an opportunity to be spoiled for choices across the sectors. This will aid in better margin performance and improve bottom line profitability and capital return ratios in the coming quarters. We appreciate your continued support and look forward to interacting with you again in the next quarter. Thank you very much.
Thank you, members of the management team. Ladies and gentlemen, on behalf of Centrum Broking Limited, that concludes this conference call. We thank you for joining us, and you may now disconnect your lines. Thank you.